I remember when I was early in my career in the life insurance industry, and I was selling the same product I sell today, whole life insurance. I was just working for other people. And I was always encouraged to sell policies with high base premium. When we talk about policy design all the time, your money can go toward premium or PUAs, but I was always encouraged or really told, hey, you should be selling policies like this with higher base premium. And the reason why was really because it generated the most compensation or commission for the agency, my manager, and me. And they would always lead with, hey, you will make the most money doing it this way. And I got it and I saw it. I'm like, okay, I do understand that. But being the nerd that I am and learning the software in and out, I started to dig into it and say, hey, wait a minute, like this isn't what I want. Can I design a policy like this for myself? And I was just told, you can't do that. And you can imagine how I'm designing that policy for myself: minimum premium, minimum commission, maximum cash value. So they tell me, no, you can't. And what do you think my answer or my response is? Why not? Like, why can't I do that? And it was just, oh, you can't, let's just move on. We don't do things like that. And why I mention this is in the insurance industry, there's a bit of a, call it a culture that goes on. And this is just from my observation where I used to work different places, and what I see when I speak to different agencies or how they operate is whatever agency or producers, single producers out there running a small business, write the most, or call it write, meaning they sell the most premium, base premium, which going back to policy design as a consumer that does not show up in cash value right off the bat, that generates the highest commission. The producers or agencies that write the most premium typically have the greatest bragging rights. They get all the recognition, companies love them because they're driving revenue for the company, which, hey, makes sense. You know, businesses are in business to be profitable. I get all that. But as I look at that, I'm not saying that that's bad, high base premium sales. Where I have an issue with it is often with whole life insurance, people are interested in it, at least the people we work with, because of the cash value. They see and hear what big banks do, corporations, wealthy individuals. That's what they want. They want to copy them. And what wealthy individuals do, what banks do, when they buy a policy, they have the majority of their cash value upfront immediately. And the commission rate on those products are minimized. So the agent makes a minimal amount because the consumer reaps all the benefits. Their value is there right off the bat. So really my thing was, hey, if people want a basic whole life insurance policy that fits into their overall planning, then hey, that's great. But if they're coming to you or they express interest in a cash value life insurance policy for the cash value, why on earth would you try to sell them something that is not in their best interest? So I'm going to go through some visuals here, but really I want to talk about the importance of how you engage with consumers, treating them as if it were you, because when I first started, I was nerdy with the software. I dug into policy design. I was told, hey, you should sell policies like this. I saw the software. I saw what could be done. I said, hey, why don't we do it this way? And again, I was told, well, we don't do that, or you just can't. You could. It just generated next to nothing in commission. So the first thing that I feel you should always think when working with anyone is, what if it was me? And not saying, hey, if it's me, I would want this because I can justify a higher base premium. No. If you were actually that person, you understand what they're trying to accomplish. Maybe they want a cash value life insurance policy so they can slug a lot of money away, pound a lot of money into the policy, use it as a personal line of credit. Having that cash up front is critical if that is their goal. If you were them, what would you want to see? And from a business perspective, if you do this, you're going to grow no matter what, 10 out of 10 times, because you're a resource for the person, not someone just trying to force a sale. Like if I sell you what I want to sell you, what's going to happen? You're going to go look for what you want elsewhere. You're going to keep asking me questions. You're going to feel like you're fighting me. It's going to be awkward. No one likes that feeling. I don't. We've all been there. Here's one of the most important things. Listen. Listening to the consumer to hear what they are actually interested in, that will go such a long way. If you're a consumer, you appreciate this. Or if you're in sales or business, if you've been on the other side, when you listen to people, that's how you win at the end of the day. Answer questions directly and use visuals where possible. Let's take a look at an example. I want to see one. So a question we get a lot of times is, hey, Steve, I've been looking at a whole life insurance policy. I'm interested in the banking concept, whatever it might be, and I'm just not getting the cash value. I think it can be better. Like when I pay $1 into a policy, I have nothing in cash value, or I see 50%. Like, can I make it better? I'm trying to get more information around it. And the answer is yes. You know, when you design a policy, you can have anywhere from 0 to call it 80 to 90% of your payment in the first year. But as I just said that right there, if you're not in the business, that can be a little bit confusing. So, excuse me. So when you have the opportunity to use visuals, do so. So here's a policy, very basic, $10,000 per year going in. Same company, same product, same out-of-pocket for the client. First one on the left is we see 100% premium. You know, where we talk about where money can go toward the premium piece or directly toward PUAs, which grow cash value immediately. This is all premium or all insurance expense. There's your cash value right off the bat. What's highlighted in yellow is when he breaks even. So year 13, he's paid in a total at $10,000 per year of $130,000, and he has just about $130,000. Then we've got this middle option, 50-50 split, which means he has 50% of his payment toward insurance premium, expenses, and the other 50% plowing toward cash value. More upfront, we see. Break-even point is better than the last one, $90,000. He has more long-term as well. But still, if you're interested in cash value, which you want to put 10 grand in and see half of that just go out the door to buy a life insurance death benefit, if you're in a position, which I hear all the time people express this, I don't care about the death benefit, probably not. But then you've got this option. Same company and product, 10,000 going in, about 88% right off the bat. He's positive by year 5. And he's got more short-term and long-term as well. It just gets better and better over time. And this has to do with the design of the policy and company selection, things we talk about all the time in our technical videos. But listening, when someone has a question, answering it directly, not beating around the bush, so important. We're going to look at an example of a very popular question at the end of this video. Tone. This is important, and recording yourself or having someone that can speak honestly to you and give you constructive criticism about your tonality when you speak with individuals can be helpful. And we've got to be humble enough to take that criticism, but be respectful, humble. Think of it this way. When you work with people, do you like when they are humble, when they're respectful toward you, when they listen? Here's a big one. Don't get annoyed. So if you have to explain something to someone over and over again because you feel like they're not getting it, that's not on them. No. First, remember where you started. You're in the industry, so this is me talking to you as an agent if you're in the business. But how long did it take you to accumulate that knowledge? It takes time. It took me several years to learn a lot of this stuff, and I'm still learning as we always encounter new tax laws, product changes, all that good stuff. But here's my big thing. It's one thing to have knowledge on a particular topic. It is a completely different thing to communicate that effectively. If you have to repeat yourself, it means that you, the professional, did not explain it properly. Simple as that. That's the truth. Don't blame it on the client. Don't say, oh, you got to do more research. You got to change your thinking, something like that. No. If someone didn't get it, explain it again. Explain it in a different way. Use visuals, demonstrations, illustrations, whatever it might be. Practice, that's the key. Practice, not communication, effective communication does not come naturally to everyone. It doesn't for me. Like you've heard me say that before. Practicing it over and over again. This way the tonality is proper, the pace is proper, good use of illustrations. Like you can have the best product in the world, but if you can't communicate it effectively, like you're not going to reach the audience you're looking for. And if you struggle with that, partner with someone who is good at communication or develop it. And that's fine. We can practice. Practice makes perfect. So just remember this. Don't get annoyed. Don't blame the client. No. It's you. Practice, and it'll help you too. People will see it and they'll appreciate it as well. So let's go through some examples of directly answering questions with visuals here. Here's a question we get frequently. Should I borrow from a policy for real estate, but should I do it when I look at the policy? It doesn't make sense because my cost to borrow is higher than my earning rate. And this frustrates so many people to death. Real estate investors, business owners, where they're told, hey, when you pay money into a cash value life insurance policy, it's compounding for you forever, the entire balance. So you can borrow from it and experience that uninterrupted compounding. You're going to have all this money. And that's true, it's powerful. But where people feel hurt or taken advantage of is when they actually crunch the numbers, they say, wait a minute, like I get that I'm earning compound interest on everything, but I'm paying more on the outstanding loan than what I'm earning. Like from a numbers perspective, I, the consumer, am not comfortable with that. Can you please explain to me why it makes sense or show me some alternatives? Remember, if you're the client, so if it's you and you feel uncomfortable with that, do you want someone to come and try and explain to you, hey, well, it does work, you just kind of have to trust the process, go through it? No, like you got to show me it in reality. What works, what doesn't work. Think again, if it's you, be respectful, tonality's got to be proper here. How do you address that objection? Here's how we do it. Provide transparency. Now we've got videos where we walk through this in full detail. I'm not going to do that in this video, as much as I would like to. All right, 1, 2, that's okay. So what do we see here? Policy, 50 grand per year on a 40-year-old individual, breaking even between 3 and 4, everything's set up properly. But here's his annual earnings rate in the policy, and then there's the average earning rate over time. He's taking a policy loan. The net cost to borrow, you can see it over here. What is it? 4.31%. So he's borrowing at what? 4.31% over time. What is his earning rate as you look at this? Is it 4.31% at any point in time? No, I don't see it at 4.31%. So what does that mean? This frustrates people. All you have to do is be direct with them. When I say direct, just straight up. It's okay if you're offering a product to point out the negative features of it. Yes, talk about the good features, everything, why you buy it, why you own it, why you believe in it, but don't just brush over the things that a lot of people object about. If you do that, it ain't gonna go that well. So annual IRR, if we look at the peak, say at age 50, 4.14%. That's what he's actually earning on the policy annually. His average IRR is just over 3%. People look at this and say, okay, if I take a loan, 300 grand in this example for some real estate, that might produce me, 12%, whatever it might be. But I look at this, my cost to borrow is 4.31%. 2 objections. 1, I'm not earning that, so I feel like I have a negative spread. And then 2, I can find a better rate in the market. Like, it doesn't make sense. So this is an objection. What you don't want to do is try and force someone to do something that they're not comfortable with. Has anyone ever tried to do that to you? No, it's not going to work. We'll explain, hey, the advantage to this is you have complete control. When you take this loan out, you can pay it back however you want, whenever you want. You cannot pay it back, so that you've got some advantages there. There's a ton of advantages. But with that said, if you're not comfortable with the loan rate, a nice alternative that a lot of people consider is this. A collateral loan. We talk about this frequently. This is leveraging the exact same policy. We're not borrowing from the policy now. We're taking it to a bank or a lender, obtaining a third-party loan, typically a line of credit. Very easy to be approved for, minimal underwriting, quick turnaround time. And look, same policy here, IRR, annual and average. If we look at the same point in time at age 50, 4.14, 3.12 on the average, and there's your cost to borrow, 3%. If they're larger loans, sometimes you see it at 3%. It's rare to see it lower, but you can get it depending on the policy type and policy size that you have. My point is now all of a sudden, we've got that safe, liquid, tax-free asset to position money. We've got the death benefit as well, which is fantastic. But in respect to the cash value, keeps on growing. And now I'm actually earning more than what I'm leveraging it to borrow. to borrow against. So now it makes sense from the numbers. And I can always switch back to the policy loan if that makes more sense in the future. Awareness is the key there. You have to build the awareness, answer the person's questions with transparency, use visuals where appropriate, and where's the big thing again? Don't get annoyed with them with this kind of stuff, because this can take some time to explain, can take some time for someone to grasp, whether it's before they start a policy or, more importantly, after they start a policy. So important to do that. That's where I've seen friction occur in the industry, because people feel like agents feel like they've got to explain something after the sale, so they're not getting paid for it. No, you got paid up front, so you do owe the person that time to really explain to them the pros and cons there. And then lastly, always a hot button question: what do you make in commission? Be upfront with it. And you can go through your specific rates, you can provide transparency. This usually comes up in competitive situations where someone asks, hey, like, the numbers that I've seen with another agent or with you are much better than what I was presented elsewhere. And it's the same company and product. Like, what is going on here? Is it the commission? Comes up frequently. Now, if you get that question as an agent, do not badmouth the other person. No, don't do that. Just be transparent. Show them how it works. Do not be negative in this case. So what are you making commission? Well, the commission rates really are primarily driven off of the base premium. So going back to where money can go, the premium, or toward the PUA component, premium dollars drive compensation really in the first year. Rates range from anywhere from 50%, sometimes less with some products, all the way up to 130%. Give you a quick example. This was an actual case we encountered recently where someone was presented a whole life insurance policy. He sent this to us before he started it. He's got a 1035 exchange. The commission was actually higher than what we're showing here, but big dollar amount, right? He's paying in $1.5 million over 5 years, so $300K per year, plus a 1035 exchange. Here's the agent commission with the first option he was proposed, over $150,000 on one transaction. This guy is 100% interested in the cash value. Like, that's why he wants it. The death benefit is great, but he's interested in the cash value. Is this policy, aside from what the commission is, maximized for cash value? The answer is no. You may have seen our commission study video on this, but we looked at the same product, same company that's juiced for cash value, guaranteed and non-guaranteed. But to sum it up, different company, but that's a different company with a lower commission rate, but really with a minimum premium. What is in yellow is your break-even point. When he gets back his $2 million total that has gone in, $2,060,000, the 1.5, plus the $560,000 1035 exchange. There's the difference in cash value over time. Guaranteed, it was even more significant when you look at the guaranteed values. But here's the stark difference. The agent commission, especially up front, it's massive, isn't it? It's almost 5x, really, when you break it down. No, I'm sorry, 6x. My point to all of this is you must directly answer questions when people ask, and do all the other stuff too. So hope you enjoyed this one. If you have any questions, please reach out anytime. Please hit the like button, subscribe for more. It does help us, and we'll talk to you soon. Thanks again. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.